Hey, good morning, everybody. Marty Missouri here. It is the 28th of September 2022 with your midweek market snapshot. Going to keep it relatively quick, at least on the S&P chart. Going to update the daily and the 60-minute charts. Just really looking at the prospects for a bear market rally right here. The longer-term charts are still telling us the same thing. We like 3,500 as at least an initial downside target for the bear market, where we think all things being equal, although things are never all equal and they're all subject to change. But still, as we see the state of the economy, the potential for the recession that we're either already in or about to enter, in our view, being something severe versus being something mild at this juncture, and several other factors. Price target comes more from our technical analysis, but then we have this whole macro view that says how legitimate or how realistic is that. Recall that I keep saying that I think corporate earnings are the next shoe to drop, although we're getting pretty close to that target right here. Looking at economic data, looking at consumer confidence, it actually rose in yesterday's reading. It's going to be very interesting to see, because what we've complained about is that the analysts on Wall Street really haven't accurately cut earnings estimates to what we believe accurately reflects the global state of affairs, if you will. Then again, as I intimated in this morning's written note, they tend to overdo it in both directions. So now we're beginning to see earnings estimates get ratcheted down. And ironically, and I'll probably show this data as we get into next week, when you have earnings revisions that are negative, you almost always have a positive move in terms of equity prices during the earnings season, which is interesting. And then typically it's vice versa. When earnings estimates are ratcheted up and they're net positive going into earnings season, stocks tend to fall. So the companies in the former tend to obviously report better than reactionary analysts actually estimate. And then it's that forward outlook and so on. So we are in a bear market, we are in recessionary conditions, and as I suggest, even with these technical patterns, it's during conditions like this where patterns and setups can often fail. I think I said the other day, looking at, I can't recall exactly what indicator it was, but if we were in bull market conditions, I'd be crazy short-term bullish, but we're not. We're in bear market conditions. Compelling technical setups can certainly fail. Bullish technical setups can certainly fail when we're in bear market conditions. Nevertheless, sure looks like a rally should be at hand. I mentioned this morning's note that I thought that was beginning to occur yesterday, and then there was a whole plethora of stuff that was just too much weight for the market to keep on its shoulders, and it rolled over. Today was very interesting coming into it. Futures were nicely green overnight, again, anticipating the short-term stuff to play out. And then it was leaked or announced that Apple is telling its suppliers to cut back on iPhone 14 production due to lack of demand. And Apple is huge, particularly in the S&P 500, huge in the NASDAQ. So then the markets rolled over. And what that says about the state of affairs of the global economy, China took a big hit and so forth. On that news, then ironically this morning, Morgan Stanley, whose chief market strategist, has a much lower price target than we do on the S&P, came in and said, we remain very bullish on Apple. That is a non-starter. It's more noise, yesterday's announcement, and we have a 180 price target. So lots of stuff happening. That apparently has not helped the price, at least last time I checked on Apple. But here we are again, nevertheless, getting a pretty good rally. It's 87 basis points. Nick and I were discussing this a bit earlier this morning, and we had noted that at that time, the S&P was flat, but the S&P 500 equal weight, which is really a better look at the broad market, was actually up quite notably. Now, from a technical perspective, here's the daily chart, and as you can see, I pull this down here a little bit, but still, we have the makings of a bullish divergence on the MACD, particularly if we get a big rally and we turn this back up and we get a bit of a buy signal in there, which would be the white line, coming up on the green line. In terms of the RSI, just coming off of oversold levels, right? Remember right here when we hit that 200-day moving average, that was an easy call that we were going to fall off of that, which is a call that we made, but I'm sure we were in the majority there. We were overbought, right, on the RSI. So I've been showing you the last couple of videos, you get these oversold levels, and this is just, very basic technical analysis. You can play these and you can get some rallies and it'd be a fairly consistent look. And here we are, as oversold almost as we've been all year. And we're at the June lows, right? And sure enough, that's right where the market's doing battle so far. If you were to break above this trend line, that would actually be your official buy signal, by the way, when you have some somewhat bullish divergences or bullish technical setups in the momentum indicators. So yeah, you can definitely make a case here that the market is primed for a pop. And when I term it bear market rally, what I'm implying there is that it is not going to make it, and that we've got more downside left to go, or quite a bit left to go in this bear market potentially. If I had to place a price target on it, I would just kind of follow these lines. The first one would be back above this 3,800. Be interesting to see if that doesn't pose some resistance all the way up to, I'd look at that 50-day moving average and bring it down around the 4,000 mark. That would not be remotely outside the realm of possibilities, particularly if the US dollar can give up some of this steam and yields come off the boil a little bit because maybe inflation's coming down and so forth. So we'll see. But again, like I said this morning in the written note, let's not hold our breaths right here. Right? This is a precarious setup for sure. On the 60-minute chart, we have a really bullish look right here. I got to be honest with you. So we have clearly a falling wedge pattern, right? Clearly, with absolutely your bullish divergences here, and you just broke out this morning the downtrend line on the bullish wedge, right? So, by the way, what you do with these is if you wanted to create a price target out of it, initial price target out of it, you take the widest point of the wedge. This is what technicians would do, right? And then you pull that over to the breakout, right? And that would take you up. I'm just doing this with eyesight. That right there, at least the initial target would be wherever that is, somewhat shy of 3,800, but something that people would feel pretty darn good about. And then if that resulted in some sort of a flip on this gamma hedging that we keep talking about with these options dealers and or a bunch of short covering, because in the futures market, the net short is quite notable in the S&P. So remember, when the market goes up, shorts get creamed. So they cover, and that covering is buying the dealers who are hedging their put exposure, the ones who sold those puts, they're short, they cover, and you can get something special to the upside. There's very much the risk that the market breaks through here, and that hedging, it adds to the shorting, and you get something more extreme to the downside. So this does look about as good as any of the patterns we've seen this year, right? It really does. It's just the situation we're in, like yesterday, where a whole bunch of news came out and killed that pattern. So we'll see how it plays out. As I speak at you here this morning, right now, the S&P is up almost 1 full percentage point. Bonds are having a nice rally. The dollar is actually rolling over a little bit here this morning. So that's all bullish stuff for the short term. Okay, so allow me to add a little more fuel to this bullish fire, so to speak, at least short term. I don't know, I think this was on the written blog. Maybe I did it in the video. Put to call ratio, I think it was on a video. You can see it spiked up here just Friday. And that's pretty high, above 1 put to call ratio, higher put volume than call volume. You can see last time we were this high was at the very bottom of the COVID washout here in 2020, or just before the bottom. And then the 2018, almost a bear market in the fourth quarter of 2018. And it's just it's just like a one-day thing, and then it came off the boil. right now at 7.78, still on the high end of a put call ratio, but it came down. So far, although this morning we're seeing a bit of a rally, nothing like we've seen in either of these two cases, but again, it didn't even happen right off the bat here, and it did here, and then it was a sustainable end to this correction. I call both of them a correction, but officially this was more than 20%, so that would be a bear market by a textbook definition. So take it for what it is. It's just a look at the chart that says, that tends to get that high right before we get a notable rally. Back in June, I did a video and wrote an article right before the market bottom, and I said bear market rally conditions. We don't have as many things lined up as we did then, frankly, but few that we do is the crazy bad breadth here. This is the percentage of S&P 500 stocks trading above their 50-day moving average. Now, normally you'd say this is very bearish, but this is the extreme, right? From here, you get what some people call these breadth thrusts, right? So here we were, right, in June. Remember, I showed you this, and boom, we got that. Here we are again. Here we were at the bottom of COVID. Here we were at the bottom of the 2008 deal. Here we were at the bottom of that 16% correction in 2015-16. Here we were at the bottom of a 19, almost 20% correction in 2011, 14% correction in 2010, 57% bear market in 2008. You get it. So these levels right here are where the market tends to bounce from. Okay. Same thing on the percentage of stocks trading above their 200-day moving average, right? As you can see, these are areas. This is the area we pointed out in June. We got that really nice pop. Here we are again. So, for what it's worth, not holding our breaths, but for what it's worth, these are signs that, yeah, probably due for something to the upside here. And a couple more things with regard to sentiment. This is the American Association of Individual Investors weekly sentiment reading. We'll get this, I think, tomorrow or later today. So this is last week's, but I don't suspect we're going to see much of an improvement there. Look at the percent of bulls. By the way, the average for that is 38.0, and the percent of bears, where the average is 30.5. Hugely bearish setup right here, folks. So at least as they answer these surveys, individual investors are all sitting on the fear side of the boat. And as I said yesterday on the written blog, it can get tough to breathe over there when it's that crowded. So what happens? You get something encouraging in the news, what have you, and then the big mad dash rush from one side of the boat to the other because the boat is really tilting over here. Sparks a big rally in this case, and when we're in the opposite of that, it can spark a big sell-off and so forth. So this is unambiguously bullish from a sentiment standpoint, and this is part of our fear-greed index, which is actually saying, fear it's like scored at 50, our last scoring a few days ago, and that's a high reading. 100 is the highest, but 50 is high enough for a short-term bull, somebody who wants to game a short-term trade might want to go long the market. And then the bull bear spread, this is good stuff. We pay for this from Investor Intelligence. They've just dipped further into the red, meaning the 9% more bears than bulls out there among advisors / newsletter writers. And here's their graph. Here's where it was in the end of 2018. Here's where it was in the bottom of the COVID low. Here's where it was. I was showing you this at the June low when we got that nice rally. And we're getting down there again. It's not where they say, back up the truck, as I like to say, but it is something that would be net bullish because, again, it's getting crowded on the bear side of the boat. So, folks, there you have it. We'll see how this plays out. Interesting stuff. I know many of you clients and non-clients alike seem to be, the feedback I get is that this is valuable information for you. For us, we focus more on the long-term charts and the macro setups and so forth, but we do pay very close attention to the short-term dynamics, looking for things to potentially break in one direction or the other. We're sitting on quite a bit of new cash that's come in, waiting to allocate, and we're not at all impatient here. But like our internal discussions have been around the fact that it just insanely bearish out there, and I could name probably a dozen legitimate reasons why. I will tell you this, it tends to be absolutely darkest before the new dawn. And while they're more probably to play out right here, we need to be open to the possibility that we may be getting pretty close to a bottom. If it was backed into a corner, I'd say right now, based on our assessment right now, always subject to change, sometime between now and the end of the first quarter of next year, makes a lot of sense to us for this bear market to have carved out a durable bottom. So time will tell. We'll keep reporting as we go. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.